Hey everyone, this week I'm going to focus on the 2026 multifamily investment forecast. Now, we're looking at a bit of a complex year for the multifamily sector. There are a variety of headwinds and cross-currents that will shape multifamily performance over the short term. But by the same token, there are significant tailwinds that will bolster the multifamily sector over the longer term. High development Sunbelt markets likely face the greatest short-term challenges, while metros with limited construction sustain their momentum. Over the last 3 years, more than 1.4 million new apartments have been added nationally. That's the most robust pace of multifamily development on record. But it was met by unprecedented apartment housing demand, which helped restrain vacancy rates. As of the third quarter, the national average multifamily vacancy rate stood at 4.6%. That's down 130 basis points from the cycle peak of 5.9% set in early 2024. But the pace of absorption has begun to taper. And there are a variety of factors driving that. Uncertainty has been exceptionally high since the Liberation Day tariffs were announced in April, and that has weighed on the pace of hiring. In the first 4 months of 2025, the U.S. created nearly 500,000 jobs. But in the 5 months between May and September, only 193,000 jobs were added. And while the national unemployment rate ticked up to a still low 4.4% as of September, the key 20 to 28-year-old renter cohort faced a much less favorable employment market, with the unemployment rate for this age group rising to 7.4%. At the same time, consumer sentiment has dipped to one of its lowest readings on record. This combination is slowing the pace of new household formations, which will weigh on new multifamily demand in 2026. Markets with the most development will face the greatest challenges in the coming year, especially as domestic migration to southern metros has tapered from the peak levels following the pandemic. Vacancy rates across the Sunbelt now stand nearly 200 basis points higher than the average across non-Sunbelt markets. And average effective rent growth in these high development markets has been running negative for the last 3 years. Metros with limited construction will generally continue to deliver solid performance in 2026. Now, despite the short-term headwinds, the longer-term multifamily outlook remains positive. The pace of construction has slowed dramatically, with the number of units under construction down 53% from their peak in 2023. They're now on par with 2015 levels. In addition, the cost of homeownership remains prohibitively high, with the monthly payment on a median-priced home running nearly $1,200 higher than the average apartment rent. This barrier to homeownership will continue to favor rental housing demand, supporting lease renewal rates that currently stand at 55%, well above the long-term average. At the same time, the headwinds slowing household formation are likely temporary. They're simply deferring some of the demand for apartment housing until uncertainty abates. As job creation revives and consumer sentiment improves, household formation should reaccelerate and apartment absorption could surge. In addition, new supply risks over the next few years will remain limited as elevated material and construction labor costs restrain developers. So, while the short-term multifamily outlook remains choppy, with low development markets likely outperforming markets that have had significant multifamily additions, the longer-term outlook remains positive. Ultimately, the U.S. still faces a housing shortage and home prices remain prohibitively high. So as economic uncertainty abates and the pace of hiring accelerates, multifamily performance could improve quickly. The big question is timing. The economic climate could reinvigorate in 2026, or it may take more time. But once it does shift gears, multifamily housing demand could rapidly outpace new construction, driving vacancy rates lower and boosting rent growth. And that shift in the market is the trigger to watch for. That's why it's so important for investors to keep their eyes on the horizon.